Welcome to Market Brief After Hours. We have a massive amount of ground to cover today. It was a highly volatile session across global markets, driven by a sharp surge in oil prices and escalating geopolitical tensions. The Dow has slid to a new 2026 low, and oil has officially surged past the $100 mark. Let's break down exactly what happened out there today.
It was an incredibly intense day on the trading floor. The situation in the Persian Gulf is completely dictating investor sentiment right now. When you have the Iran war intensifying and genuine threats to the Strait of Hormuz, the market immediately prices in the worst-case scenario for global energy supply.
Let's start with the key takeaways from the U.S. markets because the numbers are stark. The Dow Jones Industrial Average took a severe hit, tumbling 1.56%. That brings it down to close at 46,678.
Breaking below that 47,000 threshold for the first time in 2026 is a major psychological blow for investors. It really highlights the defensive posture the market is taking.
The broader market felt the exact same pain. The S&P 500 declined 1.52%, closing at 6,673. This was a classic broad risk-off session. 8 of the 11 sectors finished in negative territory today.
Exactly. And financials and technology stocks really led those losses. In the banking sector, Morgan Stanley was a major drag after they announced they were capping withdrawals from a private credit fund. That kind of news always spooks investors, especially on a day when the broader macro environment is already flashing red.
And looking at the tech-heavy Nasdaq composite, it actually fared the worst of the 3 major indices, dropping 1.78% to settle at 22,312.
That is a textbook reaction to rising oil prices and rising Treasury yields. Investors immediately rotate away from growth stocks. When energy prices spike, inflation fears follow, and growth valuations suddenly look much less attractive.
Let's talk about that oil spike, because it is the undeniable catalyst for today's sell-off. Brent crude jumped a massive 9.22% to close at $100.46 per barrel. That is the first time we've seen a settlement above $100 since August of 2022.
And U.S. West Texas Intermediate followed suit, rising 9.72% to settle at $95.73 per barrel. The primary driver here is the rhetoric coming out of the Middle East. Iran's new supreme leader explicitly stated that the Strait of Hormuz should remain closed as a pressure tactic. You also have fresh attacks on commercial vessels in the Persian Gulf. Even coordinated reserve releases by the U.S. and the International Energy Agency couldn't stop this rally. The fear of a prolonged supply shock is just too strong.
That fear definitely rippled across the Atlantic. European markets finished broadly lower today. The Pan-European Stock 600 ended down about 0.7%. Looking at specific countries, the UK's FTSE 100 fell 0.59%, France's CAC 40 declined 0.58%, and Italy's FTSE MIB dropped 0.52%. Germany's DAX 40 slipped around 0.2%, and Switzerland's SMI took a 0.9% hit.
Europe is incredibly sensitive to energy shocks, so those declines make perfect sense. But there was also some troubling economic data adding to the cautious tone. Portugal reported that its trade deficit widened to 2.51 billion euros in January. Their exports fell 14.1%, which is the steepest annual drop since 2020. A lot of that was driven by a massive fall in industrial supplies, specifically chemical shipments to Germany.
We also saw some specific corporate developments weighing on European sentiment. HSBC shares fell 6% after the bank closed its Qatar branches indefinitely due to the regional tensions, and Savills declined 7.2%, which is interesting because they actually reported stronger earnings.
It just goes to show that in a market environment like this, even good earnings can be completely overshadowed by macro fears and geopolitical risk.
The Asia-Pacific markets didn't escape the pain either. Japan's Nikkei 225 slid 1.04%, Australia's ASX 200 fell 1.31%, and markets across New Zealand, South Korea, Hong Kong, and China all closed lower. In India, the Sensex lost 1.08%, and we got news that India's consumer price index rose to 3.21% year-over-year, marking their fastest inflation pace in 11 months.
That inflation data out of India is a perfect example of what the global markets are terrified of right now. Surging energy prices feed directly into consumer prices. We saw that reflected in the U.S. bond market today, too.
Right. U.S. Treasury yields moved higher as traders assessed those exact inflationary risks. The benchmark 10-year yield climbed more than 5 basis points to 4.261%. The 30-year bond yield rose over 2 basis points to 4.879%, and the 2-year yield added more than 9 basis points to hit 3.734%.
Traders are positioning themselves ahead of the Federal Reserve's preferred inflation gauge, the Personal Consumption Expenditures Index. Interestingly, though, despite all this macro turbulence, the U.S. labor market is still showing resilience.
Yes, U.S. jobless claims actually fell to 213,000 this past week, which was below economists' expectations. Continuing claims also declined to 1.85 million.
It is a fascinating dynamic. Just last week, we had a report showing the U.S. economy lost 92,000 jobs in February. But these new jobless claims numbers suggest that employers are still largely holding on to their workers, despite the softer payroll figures.
We are going to take a brief pause here. When we come back, we will dive deep into the Forex markets, look at the key moving averages, and break down some massive single stock movers that defy today's downward trend. Stay with us. Welcome back. Let's shift our focus to the foreign exchange and commodities markets. The US dollar had a very dominant session today. Looking at the Euro-USD pair closed down 0.46% at 1.1514.
The bearish momentum on the euro is really building. The pair finished near its session lows, which signals sustained selling pressure. From a technical perspective, the price is now firmly below all the major simple moving averages. It is sitting below the 50-day SMA at 1.1751, the 100-day at 1.1693, and the 200-day at 1.1673. The technical outlook here is clearly bearish, and the pair is approaching key support near 1.1450.
The British pound painted a very similar picture. GBP USD slipped 0.50% to close at 1.3346.
Sellers have definitely taken control of the pound. The price slipped below the 100-day moving average at 1.3398 and the 200-day at 1.3443. Overhead resistance is now sitting firmly at the 50-day SMA, which is up at 1.3525. If the pair breaks below today's lows, we could see it exposed all the way down to the December 2025 lows near 1.3250.
We also saw a sharp pullback in the Australian dollar. AUD-USD closed down 1.03% at 0.7077, completely erasing much of the previous session's gains.
It was a strong bearish candle today, but it is important to note that the broader bullish structure for the Aussie dollar is actually still intact. Despite today's drop, the price remains above the 50-day SMA at 0.6948, the 100-day at 0.6759, and the 200-day at 0.6646. So while it was a sharp daily pullback, the longer-term trend hasn't broken yet.
Moving over to the Japanese yen, USD JPY extended its rally, closing up 0.28% at 159.38.
The upward momentum here is incredibly strong. The pair finished near the session high and is marching right toward the psychological 160 handle. It continues to trade well above the 50-day SMA at 156.25, the 100-day at 155.70, and the 200-day at 151.56. The bullish trend across all time frames is very well reinforced.
Let's look at precious metals. Given the geopolitical fear, you might expect gold to soar, but gold actually pulled back from its record highs today, closing down 1.69% at $5,089.
It was a large bearish candle today, but this looks more like a sharp correction following a very extended rally rather than a complete reversal. Gold is still sitting comfortably above its key moving averages. The 50-day SMA is down at $4,912, the 100-day is at $4,543, and the 200-day is way down at $4,022. The broader uptrend is definitely preserved.
Silver followed a similar path, retreating 1.36% to close at $84.59.
Silver is now approaching its 50-day SMA at 86.23, but just like gold, it remains well above the 100-day at 70.99 and the 200-day at 55.39. It is maintaining a strong long-term bullish structure despite today's sharp correction.
Finally, let's wrap up with today's market movers. Even on a dark day for the broader indices, we had some spectacular individual stock performances. Petco Health and Wellness had an absolute monster session, surging nearly 35%.
That was one of the biggest bright spots of the day. Petco signaled that it could return to revenue growth this year, guiding for full-year sales to range between flat and up 1.5%. After a tough stretch for the company, investors aggressively bought into that turnaround forecast.
Bumble also had an incredible day. The dating app stock jumped 34%.
They delivered a phenomenal fourth-quarter earnings report. They beat Wall Street expectations on both revenue and adjusted EBITDA. In a market that is heavily punishing weakness, a strong double beat like that will get heavily rewarded.
We also saw Firefly Aerospace jump about 12% today.
That jump was driven by the successful launch of their Alpha Flight 7 rocket. It is a huge milestone that massively boosts investor confidence in their launch capabilities and their future commercial prospects.
On the negative side, Lucid Group slid over 7%.
The electric vehicle manufacturer gave a very sobering update on their long-term cash flow outlook. They stated they do not expect to become cash flow positive until later this decade. In a high-yield environment, investors simply do not have the patience for timelines that long.
And Netskope took the hardest hit among our movers, plunging 22%.
The security firm issued a very weak outlook for both the first quarter and the full year. They are projecting larger losses than the market anticipated. And as we saw today, the market has zero tolerance for weak guidance right now.
It truly was a session defined by sudden shifts and massive volatility. Thursday's sharp sell-off is a stark reminder of how quickly geopolitical developments in the Persian Gulf can rewrite the rules for global markets.
Without a doubt. The surge in oil prices and the severe uncertainty surrounding the Strait of Hormuz have forced investors into a highly defensive stance. Equities are lower, Treasury yields are higher, and for the foreseeable future, market sentiment is going to be chained to the trajectory of the Iran conflict and the price of crude oil. It will dictate inflation expectations and broader market direction in the days and weeks ahead.
It is a critical time to stay informed and watch these levels closely. Thank you for joining us for tonight's breakdown. If you find this useful, please follow Market Brief after hours.